Today, we're hopping into my portfolio and we're taking a look at the dividend growth portfolio. Now, if you haven't followed me before, I have my investments split into two different categories. One of them is the growth portfolio, which is very concentrated with very offensive, high valuation growth companies like Salesforce, Google, Amazon, and Crocs. Now, the dividend growth portfolio is a very defensive, slow-growing, high dividend yielding companies, and last time we showed an update we had 19 companies, and now we only have 18. We sold out of one, and this dividend yield in this portfolio currently sits at 3.558%, which is now actually higher due to the company that we sold out of. And we're going to talk about the 4 companies that were involved in this shift, because if you look at my holdings tab, you can see the weighting of my growth portfolio, and then the weighting of my dividend growth portfolio is shown as below, but there are 4 companies that have seen changes. And the 4 companies we're going to talk about today is JP Chase, Caterpillar, Whirlpool, and Target. So we're going to talk about all 4 of these companies. We're going to look at all sorts of financial metrics, valuation, talk about the sector they're in, and then the stage of the economy we're at, and trying to weight my portfolio based on different prices of different companies and just overall trends that I see into the future going into 2023. So it's going to be a fun one. Let's go ahead and get started. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, welcome back, and let's go ahead and take a look at JP Chase. As you all know, it's the largest bank in the world in terms of market cap, and it's one that's been a long-term grower. Most recent quarter grew 10% revenues, and profitability is down significantly, down 178% on a quarter-over-quarter basis, which is pretty skewed considering it's a quarter-over-quarter. You can see year-over-year, it's kind of all over the place as financials tend to be due to recessions and economic booms and different reporting metrics that are very critical to banks. Now, I'm not going to go line by line over this. It's very, very in-depth for this earnings report, and this is literally just the first slide. So if you want to pause this and read some of the financial metrics, you can see what it's doing in the most recent quarter. But generally speaking, this is not one that I'm looking so much in terms of like trying to model out some earnings report or some revenue growth like I do with most of my companies. JP Chase is very simple. It's one of the best hedges on the economy, and it's what I consider to be the most profitable, most efficient, best branded bank on the planet. It doesn't get to a $400 billion market cap on accident, and now that it's reached a valuation that I consider to be very full valued, I don't want to be buying this company as aggressive as I has been. It recently was a 10% weighting in my portfolio. I'm taking it down just to a smaller 9%. It could go down more depending on where the stock price goes, but as the last time I checked, its price to book is around a 1.6, which is not that cheap considering the stage of the economic recession that we're in. So JP Morgan, I was buying very heavily, right around the 110 to 100, and at one point it dropped almost below that $100 range, and I was expecting to load up on more, but now it's recovered heavily back into the 130s. So a 30% uproar is reason for me to not really sell out but lower my target weighting, because as it is a company that is very profitable, it's very large, it's one, like we said, looking at these earnings report, it's all over the place. Some quarters very profitable, $85 billion of profit, and the next quarter it swings to $42 billion in losses. That's just the way this company goes, and it's really one that will follow the economy. So it's one that I'm going to be holding on to. Still a large weighting in my portfolio, but it's going down a peg. Now, speaking of going down a peg, we're going to talk firstly about the 2 that I'm going down, and then we'll talk about the 2 that's going up. Caterpillar is one that has done very well. And this is really one that simply, in my opinion, has just done too well considering that we're going into a recession, because its stock price as you can see, is pretty much at all-time highs. Let's go to the all-time chart. You can see that it's had ebbs and flows, ups and downs throughout economic booms and economic busts, and really this is one that's sensitive to the economy. It's one that a lot of people would refer to as cyclical, because that's what this is, a cyclical business. And looking on the 10-year chart, you can see over time it ebbs and flows, like I said, but right now we're basically at all-time highs. Let's zoom in a little closer. Let's look at the 5-year chart. You can see that this company is significantly higher than where it was just 6 months ago. It is doing very, very well, and year to date, it is still up 12% despite the economy and almost every other big cap stock out there being down. So it's true that the results are doing very well. The revenue growth is almost at an all-time high. The profitability is basically at an all-time high, very close to it. And some of its metrics are looking very good. Generally speaking, they're all going in the right direction, but what I see forecasted into the future for Caterpillar is a down stock price. The stock price, in my opinion, is just holding up too resilient. It's doing too good in this economic recession, and there's just flat out better companies to be buying. Furthermore, if you look at the dividend yield, it's not nearly as juicy as many other dividend investors would want it to be. It's currently at 2.06%. A 2% yield is okay, but it's not that great in this type of environment. So it's one that I'm going to be selling out of completely. It originally was 2% of the portfolio. Now it's 0, and that's why we're now down to 18 companies instead of 19. Next, we talk about Whirlpool. This is one that I really think is an interesting play because the business is doing it's an okay business. It's not one that I love, but it's one that right now is producing ridiculous amounts of shareholder returns. I just want to show you how crazy it is looking at this company over the long term. Look at its dividend policy. Last year it was raised 25%, and over the last 10 years it's gone up 13.35% over the last decade compounded. It's went from a previous 23 cents to 25 to 28, 31, 34, 43, 50, 63, 75, 90 cents, $1, $1.10, $1.15, $1.20, $1.25, $1.40 to $1.75. It's continually gone up and has started to pick steam over the last year or two. Furthermore, this company does a lot of share buybacks, and in the most recent quarter, you can see that year over year they bought back 12% of the shares outstanding. 12%. Do you realize how insanely high that is? If we compare that to many of the other companies out there, like for example, Apple does more share buybacks than any other company on the planet. And if you look at their shares outstanding year over year, their shares have gone down about 3%. 3% is actually very good, and Apple spends a lot on share buybacks, and so that's essentially like getting another 3% dividend of sorts, because your cash flows, you own 3% more of the business and the cash flows that you didn't last year. But Whirlpool is a 12% buyback. That is over 4x that of Apple's. You can see just 1 year ago, the company's shares outstanding sat right at 62 million. This year, it sits at 54 million. 12% of the company bought back is ridiculous, and while the company's growth is very lackluster and not one that's very impressive at all, when you consider that they have a buyback policy that's in the high single digits most years, and they're paying back a current dividend yield of 5%, it's very easy to see that the actual earnings will generate returns for shareholders in the form of return capital at around 10-ish plus percent, likely over 10%, likely 12 to 14%, so that's pretty incredible when you consider that. Next, we'd look at, and I forgot to mention, Whirlpool went up just 1%. It was previously 5%, now it's 6%. So now we jump into Target, which we increased 2%, and this is one that's doing very well, and it's one that I'm going to consider to be a stronghold for the economy. It's one that's likely going to hold up pretty decent no matter what happens, whether this economy recovers very quickly, whether we stay in a deep recession, and they're doing very nice, and they're an excellent hedge against inflation, which is why you see the recovering revenue going up quite nicely. Now, profitability is faltering due to inventory issues and obviously inflationary pressures and a recession starting to finally take place for Target. And while I think this is one that may face some headwinds, you can see this is one that does return a lot of capital, like Whirlpool, raised its dividend 20+% year over year, and is buying back a decent amount of stock at 5% over the last year. Now, while profitability is faltering right now, they have burned through a lot of their cash, which I don't like, but I am increasing it because right now you can get a juicy 3% dividend yield for what I consider to be one of the most stable businesses on the planet, because Target is not going away anytime soon, currently sitting at about a $70 billion market cap. So those are the 4 companies I changed. 2 went up, 2 went down, 1 was eliminated completely, and overall these are businesses I'm focusing on moving into this portfolio in the dividend growth portfolio right now. Thank you guys so much for watching. Check out all the stuff down below in the description if you haven't already. Thank you MooMoo for sponsoring this video, and I'll catch you all next time.